Capital market theory. We all know that co-movement, which is measured by an asset's covariance with the market portfolio, is referred to as an asset's systematic risk, the portion of an individual asset's total variance attributable to the variability of the total market portfolio, and non-market variance is called unsystematic risk. In this lesson, we will learn the Markowitz model, the efficient frontier, the concept of CML, market portfolio, risk-free rates and borrowing and lending rates, beta and its measurement, the capital asset pricing model, the arbitrage pricing theory. After going through this presentation, you should be able to explain Markowitz model, describe the efficient frontier, discuss the concept of CML, market portfolio, risk-free rates and borrowing and lending rates, define beta and its measurement, describe capital asset pricing model, describe arbitrage pricing theory, differentiate between CAPM and APT. According to Harry Markowitz, investors are mainly concerned with two properties of an asset, risk and return, but by diversification of portfolio it is possible to trade off between them. The essence of his theory is that risk of an individual asset hardly matters to an investor. This model is based on the following assumptions. These are: the return on an investment adequately summarizes the outcome of the investment. All investors are risk averse. For a given expected return, he prefers to take minimum risk. Obviously, for a given level of risk, the investor prefers to get maximum expected return. The investors can visualize a probability distribution of rates of return. The investors' risk estimates are proportional to the variance of return they perceive for a security or portfolio. Investors base their investment decisions on two criteria, that is, expected return and variance of return. The outcome of risk and returns combination generated by portfolio of risky assets that gives the minimum variance for a given rate of return. Investors will never want to hold a portfolio below the minimum variance point. They will always get higher returns along the positively sloped part of the minimum variance frontier. The efficient frontier is the set of mean variance combinations from the minimum variance frontier, where for a given risk no other portfolio offers a higher expected return. The efficient frontier represents all the dominant portfolios in risk or return space. There is one portfolio M which can be considered the market portfolio if we analyze all assets in the market. Hence, M would be a portfolio made up of assets that correspond to the real relative weights of each asset in the market. By using RF, the efficient frontier is now dominated by the capital market line, CML. Each portfolio on the capital market line dominates all portfolios on the efficient frontier at every point except M. Although there are no securities with perfectly negative correlation, almost all assets are less than perfectly correlated. Therefore, you can reduce total risk sigma p through diversification. If we consider many assets at various weights, we can generate the efficient frontier. The efficient frontier represents all the dominant portfolios in risk or return space. The optimal portfolio concept falls under the modern portfolio theory. The theory assumes, among other things, that investors fanatically try to minimize risk while striving for the highest return possible. The theory states that investors will act rationally, always making decisions aimed at maximizing the return for their acceptable level of risk. The optimal risk portfolio is usually determined to be somewhere in the middle of the curve, because as you go higher up the curve, you take on proportionately more risk for a lower incremental return. On the other end, low risk or low return portfolios are pointless, because you can achieve a similar return by investing in risk-free assets like government securities. Consider single efficient fund of risky assets or market portfolio and a risk-free asset. A bond matures at the end of investment horizon. If a risk-free asset does not exist, investor would take positions at various points on the efficient frontier. Otherwise, efficient set consists of straight line called CML. In pricing line, prices are adjusted so that efficient assets fall on this line. CML describes all possible mean variance efficient portfolios that are a combination of the risk-free asset and market portfolio. CML relates the expected rate of return of an efficient portfolio to its standard deviation, and the slope of the CML is called the price of risk. This shows how much expected rate of return of a portfolio must increase if the risk of the portfolio increases by 1 unit. Everyone purchases a single fund of risky asset, borrows or lends at risk-free rate, form a portfolio that is a mix of risk-free asset and single risky fund. But a portfolio mix of the risky asset with risk-free asset will vary across individuals, according to their individual taste for risk. Seek to avoid risk, have high percentage of the risk-free asset in their portfolio. More aggressive to risk, have a high percentage of the risky asset. Now the question is, what is the fund that everyone purchases? This fund is market portfolio and defined as summation of all assets, total invested wealth on risky assets. An asset weight in market portfolio is the proportion of that asset's total capital value to total market capital value. Capitalization weights. Beta of an asset measures the risk of the asset with respect to the market portfolio M. High beta assets earn higher average return in equilibrium because of beta of market portfolio is to average risk of all assets. Beta I R bar M minus RF. If the betas of the individual assets are known, then the beta of the portfolio is calculated by given formula. Risk and return calculated by given formula. Average risk of all assets is 1. Beta of the market portfolio. Beta of market portfolio is used as a reference point to measure risk of other assets. Assets or portfolios with betas greater than 1 are above average risk, tend to move more than market. Example: if risk-free rate is 5% per year and market rises by 10%, then assets with a beta of 2 will tend to increase by 15%. If market falls by 10%, then assets with a beta of 2 will tend to fall by 25% on average. Assets or portfolios with betas less than 1 are of below average risk, tend to move less than market. CAPM divides total risk of holding risky assets into two parts: systematic or risk of holding the market portfolio and specific risk. Consider the random rate of return of an asset I. Ri equals to Rf plus beta I Rm minus Rf plus Ei. Take expected value and the correlation of the rate of return with Rm. E into Ei equals to 0 and covariance into Ei Rm equals to 0. The total risk of holding risky asset I is sigma I square equals to beta I square into sigma m square plus sigma e square. Company or industry specific risk that is inherent in each investment. The amount of unsystematic risk can be reduced through appropriate diversification. It is also known as specific risk, diversifiable risk, or residual risk. For example, news that is specific to a small number of stocks, such as a sudden strike by the employees of a company you have shares in, is considered to be unsystematic risk. Systematic risk is market-wide risk. Systematic risk, sometimes called market risk, aggregate risk, or undiversifiable risk, is the risk associated with aggregate market returns. CAPM is developed by Sharp, Lintner, and Mossin. The model is based on the portfolio theory developed by Harry Markowitz. The model emphasizes the risk factor in portfolio theory is a combination of two risks, systematic risk and unsystematic risk. The model suggests that a security's return is directly related to its systematic risk, which cannot be neutralized through diversification. The combination of both types of risk stated above provides the total risk. The total variance of returns is equal to market-related variance plus company-specific variance. CAPM explains the behavior of security prices and provides a mechanism whereby investors could assess the impact of a proposed security investment on the overall portfolio risk and return. CAPM suggests that the prices of securities are determined in such a way that the risk premium or excess returns are proportional to systematic risk, which is indicated by beta coefficient. Expected excess rate of return of an asset is proportional to the expected excess rate of return of the market portfolio. That proportional factor is the beta of asset. The amount that rate of return is expected to exceed risk-free rate is proportional to the amount that market portfolio return is expected to exceed risk-free rate. The model is used for analyzing the risk-return implications of holding securities. CAPM refers to the manner in which securities are valued in line with their anticipated risk and returns. A risk-averse investor prefers to invest in risk-free securities. The price paid must ensure that the market's portfolio's risk or return characteristics improve when the asset is added to it. The CAPM is a model which derives the theoretical required return, that is, discount rate for an asset in a market, given the risk-free rate available to investors and the risk of the market as a whole. The CAPM is usually expressed as E into Ri equals to Rf plus beta I into E into Rm minus Rf, where beta is the measure of asset sensitivity to a movement in the overall market. Beta is usually found via regression on historical data. Betas exceeding 1 signify more than average riskiness. Betas below 1 indicate lower than average. ERM minus RF is the market premium, the historically observed excess return of the market over the risk-free rate. Once the expected return, ERI, is calculated using CAPM, the future cash flows of the asset can be discounted to their present value using this rate to establish the correct price of the asset. In this slide, we discuss CAPM as pricing model. As we know, standard CAPM formula only holds expected rates of return. Suppose an asset is purchased at price P and later sold at price S, then rate is equals to sold minus purchased price divided by purchased price. After that, rate of return is substituted in CAPM formula. Assumptions of capital asset pricing model are that all investors are mean variance optimizers, portfolios on efficient frontier. They plan their investments over a single period of time. They can use the same probability distribution of asset returns, the same mean, variance and covariance of asset returns, and borrow and lend at the risk-free rate. There are no transaction costs and taxes. This is a long list of requirements, and together they describe the capitalist's ideal world. Everything may be bought and sold in perfectly liquid fractional amounts, even human capital. There is a perfect safe haven for risk-averse investors, that is, the risk-less asset. This means that everyone is in an equally good credit risk. No one has any informational advantage in the CAPM world. Arbitrage relies on a fundamental principle of finance, the law of one price. It says that security must have the same price regardless of the means of creating that security. It implies that if the payoff of a security can be synthetically created by a package of other securities, the price of the package and the price of the security whose payoff replicates must be equal. CAPM is criticized for two assumptions. First is that the investors are mean variance optimizers, and second is the model is single period. Stephen Ross developed an alternative model based purely on arbitrage arguments. APT says that AI and BI are related if there is no arbitrage. If APT holds, then a risky asset can be described as satisfying the following relation. ERJ equals to RJ plus BJ1 into RP1 plus BJ2 into RP2 plus Bjn into Rpn. Rj equals E into Rj plus Bj1 into F1 plus Bj2 into F2 plus Bjn into Fn plus Ij, where ERJ is the risky asset's expected return, RPK is the risk premium of the factor, RF is the risk-free, FK is the macroeconomic factor, BJK is the sensitivity of the asset to factor K, also called factor loading, and EJ is the risky asset's idiosyncratic random stock with mean zero. Differences between CAPM and APT are as follows. APT is a more general approach to asset pricing than CAPM. CAPM considers variances and covariances as possible measures of risk, while APT allows for a number of risk factors. APT postulates that a security's expected return is influenced by a variety of factors as opposed to just the single market index of CAPM. APT, in contrast, states that return on a security is linearly related to factors. APT does not specify what factors are, but assumes that the relationship between security returns and factors is linear. Now let us check if we have understood the various concepts discussed in this lesson clearly. The CAPM is a theoretical solution to identity of the arbitrageur portfolio. Right or wrong? Wrong. A more risky stock will have a higher beta and will be discounted at a lower rate. Right or wrong? Wrong. The slope of the characteristic line shows the relationship of an individual security with the market. Right or wrong? Right. Before we end, let us briefly revise what we have studied till so far. The application of Markowitz model requires estimation of large number of covariances, and without having estimates of covariances, one cannot compute the variance of portfolio returns. CAPM suggests that the prices of securities are determined in such a way that the risk premium or excess returns are proportional to systematic risk, which is indicated by the beta coefficient. The model is used for analyzing the risk-return implications of holding securities. CAPM refers to the way in which securities are valued in line with the anticipated risk and returns. Optimum portfolio is the portfolio on the efficient frontier that has the highest utility for a given investor. Beta represents how sensitive the return of an equity portfolio or security is to the return of the overall market. Diversification is a risk management technique that mixes a wide variety of investments within a portfolio in order to minimize the impact that any one security will have on the overall performance of the portfolio.